I am AI avatar of CA Ratan Mundra. India's economic discussion today is no longer only about the value of the rupee. The deeper concern is whether India has enough stable dollar inflows to comfortably manage rising global risks. With the rupee weakening and external pressures increasing, policymakers are shifting focus towards strengthening external buffers and maintaining confidence in the economy. Global tensions, oil market uncertainty, and slower capital flows have increased pressure on emerging economies. Although India still has strong foreign exchange reserves, the environment has become more challenging than before. The question now is not panic, it is preparedness. India must ensure that sufficient dollar liquidity remains available to absorb future shocks and maintain macroeconomic stability. The global economy is entering a phase of uncertainty, where geopolitical tensions and higher global interest rates are affecting emerging markets. India imports a large quantity of crude oil and depends significantly on foreign capital inflows. Whenever global investors become cautious, pressure on the rupee naturally increases. At the same time, global investors now have attractive opportunities in developed markets, especially in the United States. This means foreign capital is becoming more selective. Even though India's economic fundamentals remain strong, the competition for global capital has intensified. As a result, India must actively strengthen its external position and improve investor confidence. India currently maintains large foreign exchange reserves that provide an important safety cushion for the economy. These reserves help the Reserve Bank of India manage currency volatility, stabilize markets, and support import requirements during uncertain periods. Compared to many economies, India's reserve position remains relatively strong. However, the article explains that while the reserves are large, the comfort level is not as high as before. Global shocks are becoming more frequent, imports are larger, and capital flows are less predictable. Therefore, policymakers may prefer to strengthen buffers proactively rather than waiting for market stress to intensify. India has previously used special NRI deposit schemes during periods of external pressure. These schemes encouraged non-resident Indians to deposit dollars into Indian banks by offering attractive interest rates and policy support. Such measures were successfully implemented in earlier periods, including 2012 and 2013. The strategy worked because it quickly brought foreign currency into the banking system and improved market confidence. Banks received policy support through concessional swap arrangements, which helped them offer attractive returns while maintaining viability. Today, policymakers may again consider similar measures to strengthen India's external buffers. The environment today is very different from 2013. During that period, interest rates in the United States were extremely low, making Indian NRI deposits highly attractive. But now, US money market funds and dollar investments already offer strong returns to investors globally. Because of this, India may need to offer much higher returns to attract fresh NRI dollar deposits. According to estimates discussed in the article, deposit rates may need to reach around 6 to 6.25%. This significantly increases the overall cost of mobilization and makes the strategy more expensive than before. The article highlights that attracting dollar inflows through special schemes is not free. Policymakers may need to provide swap support or concessional funding assistance to banks so that these schemes remain commercially viable. The estimated support cost could reach hundreds of millions of dollars for every large mobilization round. However, supporters argue that the cost should not be viewed merely as expenditure. The larger objective is macroeconomic stability. If external pressures intensify and investor confidence weakens, the economic cost of instability could become far greater than the temporary cost of mobilization support. Even though the strategy is costly, policymakers may still consider it necessary because external stability remains extremely important for economic growth. A stable currency environment helps businesses plan investments, manage imports, and reduce financial uncertainty across industries. Temporary dollar mobilization can also buy valuable time for policymakers to implement longer-term reforms. The objective is not merely to defend the rupee, but to ensure that the economy remains resilient while structural improvements are gradually introduced across sectors. The article explains that India's response cannot depend on a single instrument alone. A broader framework involving banks, NBFCs, industries, and infrastructure entities may become necessary. Many businesses have foreign currency obligations and require stable access to dollar liquidity. Sectors such as MSMEs, exporters, and infrastructure companies are especially sensitive to currency volatility and funding costs. If liquidity conditions tighten, smaller businesses may struggle with higher input costs and working capital pressure. Therefore, support mechanisms may need to extend beyond just banking channels. The article clearly emphasizes that temporary dollar mobilization cannot replace structural reforms. Long-term investor confidence depends on how attractive and predictable Indian assets appear compared to global alternatives. Investors look beyond short-term policy support and focus on long-term returns and stability. India therefore needs stronger project execution, better regulatory predictability, and improved energy diversification. Faster infrastructure delivery and policy consistency can significantly improve India's risk-return profile. The goal is to create an environment where global investors naturally choose India as a long-term investment destination. The central message is simple. India is not facing a balance of payments crisis, but the external environment has become more challenging. Policymakers may revive old strategies like NRI dollar deposit schemes to strengthen confidence and improve liquidity conditions in the short term. But sustainable stability will ultimately depend on India's ability to attract long term global capital. Strong institutions, predictable policies, energy security, efficient infrastructure, and competitive returns will determine whether India can maintain resilience in a rapidly changing global economy. Moon Says and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within Gift City and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations. And fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA. Comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.